Problem 20. This is another problem on repossession and hire purchase, slightly different as compared to problem 15 and 16. So that's why I chose to do it. On 1st January 2013, Ashok acquired furniture and hire purchase system from Real Aids Limited. So Ashok here is the hire purchaser and Real Aids is the hire vendor, agreeing to pay 4 semi-annual installments. Semi-annual basically means semi is dividing into two parts, so half yearly. Okay, half yearly installments. Within a year, there are two installments. So after 6 months or after a period of 6 months. So agreeing to pay 4 semi-annual installments. So basically spanning over 2 years. Four semi will be in a year, there'll be two. So 2 years to complete 4 semi-annual installments. And each of the installments was 800 each, commencing on 30th June 2013. So basically, the asset was purchased on 1st January 2013. I don't think there's down payment. And directly they start with payment of the first installment, first half yearly installment on 30th June 2013. The cash price of the items was rupees 3010 and interest of 5% was per annum was chargeable. So if we actually put this 4 semi-annual installments, if we try to get the higher purchase price, how much will it come to? 800 into 4, 3200. So basically 3200 becomes the higher purchase price and this becomes the cash price. On 30th September 2013, Ashok expresses his inability to continue and Real Aids Limited seized the property. It was agreed that Ashok would pay the due proportion of the installment up to the date of seizure and also a further sum of rupees 200 towards depreciation. At the time of repossession, Real Aids valued the furniture of rupees 1,500 at rupees 1,500. The company, after incurring rupees 200 towards repair of the furniture, sold the items for rupees 1,800 on 15th October 2013. Now, this paragraph is more applicable in the books of the hire vendor. Okay, so we'll come back to this paragraph, or we'll see what are the details mentioned here when we are solving in the books of the hire vendor. So first uh, we'll do the analysis of payment. So on 1st January 2013. Now, normally, though, we start with the day the contract was signed, but what happens here is since there's no down payment, there's nothing happening. So even if I write 1st January, I cannot show any payment because there's nothing happening on 1st January. Even though the asset was purchased, there's no down payment. So we directly move to the first installment, which is 30th June 2013. Okay, and opening balance of cash price is 3010. We know that 800 is the installment which includes the interest. So if I want to calculate the interest, it will be 3010 into the rate of interest is 5%. Let's just do that calculation. 3010 into 5% into 6 by 12. Why have I done 6 by 12? Because it's for a period of 6 months. 5% per annum. So how much is it for 6 months? So that will come to 3010 into 5% into 6 by 12 comes to 75 rupees. Okay, so 800 minus 75 will be 725. So 3010 minus 725 comes to 2285. Okay. Now, like I said, even though the default happens on 30th September 2013, our next installment would be 31st December 2013, but the default happens before that. Since we are used to preparing the table, I will prepare the whole table. Okay, even though it's not required further, but I will just prepare just so that if I follow something different, you may get a little confused. So we'll just we'll try to stick to our steps. So 2285 again, 2285 into 5% into 6 by 12 gives me 57. Oh, sorry, the installment is 800. Write that everywhere here. All the installments are 800. So 57 minus 800 comes to 743. Okay, so 2285 minus 743 comes to 1542. Coming to the next one, so we have finished four semi-annual installments. We have finished two installments, both in the same year, okay, half yearly. Next will be 30th June 2014, 1542. So here we have 1542. That comes to 39, and 800 minus 39 is 761. So 1542 minus 761 is 78. Then the last one, 31st December 2014, 781. We write the same thing here, 781, because we wanted balancing, and this comes to 90. So we have a zero balance. So if we total this up, it should be 3010. This should be 190, and this should actually be 3000. Okay. So now let's start again. I'm going to do it in the books of both the parties just so that we get a complete idea. So in the books of Ashok, the books of the hire purchaser first. Okay. So the first entry is recording the purchase. So it will be in the books of Ashok. We'll just name the accounts. I think it is furniture account. Furniture account. Then we have real aids. Furniture account. Then we have real aids account, and finally we have interest account. Interest account. Okay, so then we will see in the books of the hire vendor. So the first thing is furniture account debit to real aids on 1st January 2013 to real aids, always by the cash price 3010. Same date, 1st January 2013, buy furniture 3010. There's no down payment happening. So we directly move to the first installment, which is 30th June 2013. So when it comes to payment of the installment, we have a sequence to follow. We start with the interest. So the entry is interest account debit to real aids account. So on 30th June, we have buy interest. Yeah, and the first interest is 75 rupees. 75 rupees. So if we say buy interest here, on the same date, 30th June 2013, to real aids 75. Then we move to payment of the installment after the interest. Real aids account debit to bank 30th June 2013 to bank, which is 800. Okay. We also have depreciation in this problem. Now, I just want to make a note with regard to depreciation. Always remember, depreciation is charged at the end of the year. Okay, depreciation is charged at the end of the year. Here, in this case, it will be actually at the end of the termination of the agreement, because after that nothing happens. After that nothing happens, and the asset is used. So basically, when we are on 30th June, we know that we don't have to charge depreciation because this is mid-year. Depreciation is not charged mid-year, just charged once towards the end of the year. So we'll have to look at depreciation a little later. So we can't charge depreciation right now. Then we also have, what we used to do is transfer this to the profit and loss account. But again, it's transferred to the end, not every time an installment is paid, but everything at the end of the year is transferred to the profit and loss account. So we are still not at the end, we are mid-year. We've just finished 6 months in the year. Okay, so we don't have the profit and loss account entry as well. I've done some problems like this where we have half yearly installments or quarterly installments. We wait for the year to end and only then we do the transfers. Okay, so depreciation won't be charged, neither will the interest be charged the profit and loss. Now, our next installment actually, we've shown the interest, we've shown the installment. Our next installment is actually on 31st December 2013. Okay, now this is where the problem is slightly different. On 31st December 2013. But before that, what they tell us, let's just read that. They said our next installment is on 31st December 2013. But what happens on 30th September 2013, which is before 31st December? So they don't even reach the second installment, but on 30th September, soon after payment of the first installment, Ashok expresses his inability to continue and real aid seized the property. It was agreed that Ashok would pay the due proportion of the installment. Now, this is something that is different from the previous problem. Okay, in the previous problem, what I've done in repossession, the hire purchaser does not pay at all. He does not pay anything with regard to the installment, neither the interest. But here, he has agreed to pay due proportion of the installment. Now, the total installment, as we know, is 800. Due proportion means what? 800 is for 6 months. Due proportion we'll have to calculate for that period from the previous one and the date on which he expresses his inability. So the due proportion of the installment up to the date of seizure and also a further sum of rupees 200 towards depreciation. So here the hire purchaser is making a payment, not the payment of the full installment, but some part of it. Okay, and if he's making the payment of the some part of the installment, that means he's paying the interest as well. So we're going to show that entry as well for the interest. So on now, instead of going to 31st December, I'm going to show it on 30th September because all this is now happening on 30th September. They are not reaching 31st December at all. Okay, so I'm going to show by interest now. We'll have to recalculate the interest now. Okay, and how will we recalculate the interest is basically, okay, now actually the interest we had calculated for the second installment is 57. The interest that we had calculated for the second installment is 57, but I can't take it as 57 because 57 is for 31st December. Okay, so I have to either take half of 57 or I'll have to recalculate it. So what I'm going to do is I'm going to basically do it as 2285 into 5% into, now our last installment was 30th June. Okay, the next is 31st December, but we are not paying it on 31st December. On 30th September itself, he decided to discontinue but pay due proportion. So from 30th June to 30th September, what is the time period? We have the entire July, August, and September. So it's going to be basically be 3 into 12. Now, if you do this calculation, you get 2285 into 5% into 3 divided by 12. You basically get 28.56. Okay, and even if you make half of 57, it will be some 28.5 or something like that. So we'll just round it up to make things more convenient and make it 29. You can either say this or you can say or 57 divided by 2. Why I said divide by 2? Because it's after 6 months. Is that clear? You can check whatever, you see whatever is more understandable to you. So by interest 29. So if I say by interest here, it's going to be on 30th September 2013 to real age 29. Okay, this closing doesn't happen here actually. Okay. So also he's paying a part of the, we are showing the outstanding interest, and also he's also paying the installment, a due proportion of the installment. Okay. Now this is the difference from the previous problem. In the previous problem, he doesn't pay anything. There's a complete default, but here he pays part of it. And how much is he paying? Let's see. It was agreed that Ashok would pay the due proportion of the installment up to the date of seizure. Now we know that the installment is 800. Each of the installments are 800, and this 800 is for 6 months. But right now, after 3 months, after using the asset for 3 months more, after 30th June, he agrees to terminate uh, the agreement. Okay, so we are going to calculate it this way. It's going to be 800, 800 is for 6 months. So 800 into 3 divided by 6. Does it make sense? 800 is for 6 months. We only need to know for 3 months. Okay, out of 6 months. So if you do this, you get 800, 800 actually divided by 2, which is 400. Okay, so that's equal to 400 plus he's paying something else, due proportion of the installment up to the date of seizure, and also a further sum of rupees 200 towards depreciation. So he's not only paying part of the installment, but he's also paying part of the depreciation. Now don't confuse this depreciation by the depreciation that he has to charge. He's paying an additional amount to the hire vendor because he has used the asset. Okay, and the hire vendor is also at a loss because hire purchaser is terminating the agreement midway. So he's compensating with a part of the installment and also 200 towards depreciation. So the total that is being paid is 400 plus 200, which is equal to 600. Okay, so this is the difference in this problem as compared to the previous problem. This is the only difference. Fine. Now, what happens is now on this day, this books have to close because there's nothing happening after this. These books have to close because there's nothing happening after this. So on this date, we are also going to charge depreciation. Now, though we know that depreciation charge at the end of the year, we can't go till the end of the year because all these furniture is being returned on 30th September. So we can't go up till 31st December. And we know from 1st January till 30th September, the furniture has been used, and hence Ashok has to charge for depreciation in his books. So here we also have to calculate on 30th September 2013 by depreciation on 3010 into, I think depreciation is, okay, I think there is depreciation. I think I've not mentioned it here. There is depreciation. It is 10%. Yeah, it's not mentioned, but the depreciation is there. It is 10%. I will add it towards the end of the problem. 10% into, now how many months are we charging this depreciation for? We purchase it on 1st January till 30th September, you have used it. So basically 9 months: January, February, March, April, May, June, July, August, September. Entire 9 months. So 9 divided by 12. So that comes to 226. Okay, so if you see, basically, the higher vendors also charge almost the same proportion towards the depreciation, kind of a rounded figure. Okay. Now, what we have to do is, next thing is close the books. Okay. Now, what I did in the previous closing is, if you remember, we had here, since it was on a yearly basis, I transferred this to a profit and loss account, and I transferred this here to kind of nullify the interest. But here I don't need to nullify the interest because the interest is actually paid. So this interest is an expense to the hire purchaser. Okay, so I'm going to just total this and it will directly go to my profit and loss account, which is going to, this total is 104. So on 30th September itself, the closing here basically happens on 30th September because that's when these accounts are closed. The agreement is terminated. by P and L account 104. Similarly here, now what I said here is first close the asset account and transfer the balance. So on 30th September, buy real aids. See what happens, this is the same entry. When the hire purchaser is getting the furniture, it's furniture account debit to real aids. When he's giving back the furniture, it will be real aids account debit to furniture. Okay, so because the furniture is going out. By real aids, which will be the balancing figure. So here we have 3010, 3010. We need this. This is going to be the balancing figure. 3010 minus 226, 2784. Okay, so basically the value he's giving up of the machine is 2784. So if we say buy real aids here, it will be on 30th September 2013. It will be furniture, two furniture, 278. Now finally we need to close this one. Total is 4184. 4184. Let's see, I think there is a loss. It will be on 30th September 2013. Where does the loss go? By P and L account. This is the balancing figure here, which is 107. Okay. So so all these things that are mentioned here affect only the affect only the accounts in the books of the hire vendor, not hire purchaser. But I mean all these things are this part. At the time of repossession, real aids value the furniture. Okay, how real aids values the furniture has got nothing to do with the hire purchaser. So we don't show that, but we will show it in the books of the hire vendor. Okay, so this is a slightly more complicated problem as compared to the problems that I've done, problem 16 and problem 15. That's why I just thought of doing it. So now we're going to see it in the books of the hire vendor. So who's the hire vendor? In the books of real aids. So the first is the sales account. Then we have hire purchaser who's the Ashok's account. Then we have the interest account. Finally, we have the goods repossessed account. Okay. So as usual, the first entry will be the same. We record the sales. So in the books of real aids, it will be Ashok account debit to sales. So in sales, we will have 1st January 2013 by Ashok, 3010. And here it will be 1st January 2013 to sales 3010. So there's nothing else happening on 1st January. So we directly move to 30th June, which is the first installment, half yearly installment. So we start with the interest. Since interest is an income for the hire vendor, interest will be credited and it's receivable from the hire purchaser. So it's Ashok's account debit to interest. So here we will have on 30th June 2013 two interest. The first interest is 75. Similarly, we'll have it as by Ashok here. By Ashok 75. Then we also pay the installment. So it will be, since we are in the books of the hire vendor, he receives the installment. It will be bank account debit to Ashok. So on 30th June 2013, it will be by bank. It will be by bank, which is 800. Okay. So we have done now, like I said, we don't have to close. Normally, we are used to closing after the first installment, but that happens when the installment is on a yearly basis because we are at the end of the year and accordingly we need to close the account. But right now we are mid year. Okay. Next, we move on to the next installment. But what happens with the next installment? He does not move to till 31st December, which is the next installment. But on 30th September, midway, he decides that the hire purchaser decides that he does not want to continue and he pays something. He's asked to pay something. So, how much did he pay? We've already calculated how much he paid. He paid 600. Okay, 400 plus 200. So, we have to show that the interest component again as well as that installment. So again on 30th September 2013, we don't take the interest from our table, but we take that interest that we had calculated to interest. So that's the interest is receiving. And how much was that interest? Yep, 29 rupees. The same interest. It's the same calculation. 29 rupees. Similarly, here we have on the same date by Ashok. 29. We also need to show that proportionate installment, which is 400 and 200 towards depreciation. So on 30th September 2013, by bank, which is 600. How did I get the 600? That same calculation. Okay. I can do that actually. I'll copy that calculation here so that it's the same calculation. Yeah. Now, so he has paid the part interest. Now let's see what happens. Okay. Now before going to the closing, let's see what happens. At the time of repossession, real aids valued the furniture at rupees 1,500. Now, if this was not given to us, if this was not given to us, what we would have directly done is we have closed this. Okay, we would have closed the interest account, transferred it to profit and loss, or if the interest was not paid, transferred it back to Ashok's account. We would have also uh, closed this account, and the balance would have gone to goods repossessed. The balance would have gone to goods repossessed account. But here they're giving some additional statement which says that he valued the goods repossessed, real aids valued the furniture at rupees 1,500. So this is slightly different. He is giving a value. Okay, he's valuing the furniture. So how will this entry come? It will be basically goods repossessed. He's taking the goods back. He's getting the goods. So gets goods repossessed. From whom is he getting the goods? From Ashok. So in Ashok's account, it's going to be 30th September 2013 by goods repossessed. Okay, and this is given as 1,500. So if we say buy goods repossessed here, in this account, it will be on 30th September 2013, will be two goods repossessed. In a normal situation, this would have been our balancing figure actually. Whatever was the balancing figure of this account would have been this. We would have had to calculate it, but they have given us a figure. They have given us a figure, so we write it like that 1,500. And now we can close this accounts before heading towards this. Okay, so This will automatically, we know, go to sales. Okay, transfer this to sales, to, sorry, not sales, to trading account, becomes 3010. Total this, I think the debit is heavier. So this will be 3010 70 plus 75. So it's 3114 and 33114. And I think there's a balancing figure here, which we are going to transfer to by P and L account. Okay, this is going to be the balancing figure. So the balancing figure is 240. Now, if you try to take this in the profit and loss account, it's going to come on the debit side. So that means it's a loss on valuation. He has taken it at a value that is lower than the actual value of the asset. That's the meaning of it. So it's a loss on valuation for the higher vendor, which is going to be borne by the higher vendor. Close this. This is the interest that he has earned. If you're going to transfer to P&L account, this is 104. So 30th September 2013 to P and L account 104. So if you say to P&L account, in P&L account it will be by interest, which means it's an income. Now let's just complete this. We have some additional information given to us here. He repossessed the goods, and then what did he do? The company, after incurring rupees 200 towards repairs of the furniture, sold the items for rupees 1,800 on 15 October. So on 30th September, we'll just show that. On 30th September, he also incurred repairs. Okay, so when we say repairs is on goods, he has incurred repairs. So pay to bank, the repairs are 200. And then on 15th October, he has sold the furniture by bank. See. Okay, and how much has he sold it for? 1,800. So basically, he repossessed the goods for 1,500, spent some 200 on the repairs, and then sold it for 1,800. So if you see on this, he makes a profit. So on 30th September 2000, sorry, not 30th September. Now this will be on 15th October because the last date is 15th October. The transaction or the books are closed on the day the sale is made because there's nothing else up after that. So that day we say 2, the balancing figure will go to 2 P and L. Again, this is the balancing figure. So 1,800 minus 1,700. So basically 100. Now why actually he would have made a higher profit if this was not a loss. He has undervalued it here. When I say 1,500, he has undervalued it here. So that's why here there's a loss. And then here also there's no loss, but it's a very small meager profit because of this. He's undervalued it as compared to the actual value. Why is undervalued it? Because they become like second-hand goods. So this is how this problem is